Welcome back to the deep dive. If you've ever been involved in, launching a mission-driven organization, you know the single most terrifying part isn't the mission, it's the money. Today, we are going to dive deep into the essentials of accounting. Specifically for small nonprofits and startups, we've looked at a whole stack of sources to kind of give you the foundational building blocks. And our goal here is pretty clear, right? These organizations, they're typically scrappy, running on very limited personnel, often just a single dedicated founder or treasurer. So what we need is the shortcut to making sure all that good work doesn't get completely derailed by, bad bookkeeping.
That's absolutely right. And this goes so far beyond just filing your annual tax forms. For a small nonprofit, accurate accounting isn't just about compliance. It's the absolute foundation for mission success, for growth, for long-term sustainability.
Yeah.
You're really building the organization's DNA. If you can't prove where the money went today, you certainly can't get more money for tomorrow.
Okay, so let's unpack this. We'll sort of structure our deep dive around three critical imperatives. Why don't we start with the external view, the imperative of building trust and transparency? Why is accountability so much more vital here compared to, say, a standard for-profit business? They both handle money.
They do, but their currencies are totally different. See, a for-profit, it delivers a dividend to a shareholder. A nonprofit delivers social good to the community, and it runs on the faith of the donor. So the entire foundation just rests on trust. Accountability and transparency are. They're especially important because the donor is giving money with zero expectation of a direct financial return.
Okay, I see.
So the immediate audience for your records donors, stakeholders, regulators, they need that absolute assurance that their money's being spent ethically, efficiently. And if you're small, you probably haven't built up a decade of reputation yet. You have to earn that trust with just impeccable stewardship from day one.
And if we look at the donor life cycle, this relationship is, it's existential for these small organizations. It's not just about checking a box for the IRS. It's about fostering future contributions.
Exactly. Good stewardship, which, requires good accounting. It allows for efficient and timely reporting. And this transparency, this is what truly builds that trust. Think about the kind of information a professional donor or a large foundation really wants to see. They're looking at your program expense ratio, the percentage of your total spending that goes directly into the mission versus, say, administration or fundraising.
Ah, I see. So the accounting records, they provide the raw material for that critical ratio.
Precisely. If your records are clean, you can generate that report in a heartbeat, showing them you're efficient. If your records are a mess, you look unprofessional, maybe inefficient, and you lose that trust instantly.
Okay, and this is where it gets really interesting for small organizations. Our sources emphasize that a lot of them depend on just a few key high-impact donors for a huge chunk of their budget. So how does accounting feed into managing that specific relationship?
It becomes a customized communication tool. You can't just wait for the annual Form 990 to be published. A few key donors, they often want more regular reports, maybe quarterly or even monthly updates, detailing the exact impact of their specific contribution, maybe tied to a particular program they care about.
Right.
So good accounting lets you easily pull that restricted funds data, generate a tailored report, and send it out immediately. That kind of high-touch communication backed by hard financial data, well, that's what secures the next round of contributions.
That reframes accounting completely. It's not just bookkeeping. It's a relationship tool that actually drives future revenue. Okay, now let's shift from that external gaze to the internal view. How does good accounting translate into better strategic resource management inside the organization?
Well, good fiscal stewardship helps charities make the best possible use of donor dollars, both for the outside world and for themselves. Internally, the accounting books are the ultimate operational planning tool. Nonprofits, especially startups, they're facing constant unknowns honate, grant money arriving late, unexpected program costs, shifting volunteer availability.
And the sources really highlight this difficulty for startups. They often lack a consistent funding stream or predictable expenses. They have to constantly account for the unexpected.
This is a huge challenge, and it's one that clean accounting directly mitigates. Most startups operate on a really unpredictable cash flow. You might get a federal grant, for example, but the actual cash doesn't show up until 90 days after you've already incurred and paid for the expenses.
Right.
That lag creates a critical cash management gap.
Wow.
And if you don't have accurate, real-time records detailing every single invoice, and when you expect that reimbursement, You can't manage that cash flow gap. A
Right.
startup can literally run out of money and fail, even if they have millions promised in grants. So sound accounting helps you track payables versus receivables, and that allows for dynamic budgeting and forecasting, not just relying on some fixed annual budget that's going to be wrong in 3 months anyway.
That makes perfect sense. The need isn't just for accuracy, it's for flexibility, the ability to run rolling forecasts based on delayed payments.
Exactly. And that leads to the most important strategic benefit, which is the ability to manage your overhead responsibly. Every single nonprofit is scrutinized for administrative overhead. Sound accounting lets you clearly delineate between program expenses and administrative expenses.
And this is where we see those references in the sources to courses focused on overhead and the statement of functional expenses. For our listener who might not be an accountant, what is that statement and why is it such a critical decision point?
The statement of functional expenses, or SFE, is. It's fundamentally the tool you use to prove efficiency. It's where you break down every dollar spent and you categorize it. Program services, management in general, and fundraising. It shows, visually, how much of every dollar is going to the mission versus the machinery needed to run the organization.
Hmm.
The goal, strategically, is to minimize those admin costs without crippling the organization. You need high-quality staff, you need insurance, you need good accounting software. These are all administrative costs, but they're absolutely essential for the mission's long-term survival. Good accounting helps you find that optimal spending level, avoiding waste, but making sure you're making the necessary investments.
So we're really talking about distinguishing between wasteful overhead and mission-enabling overhead. It sounds like if you scrimp too much on administrative support, your programs will ultimately suffer, even if your ratio looks great on paper for a year or two.
That's the tension. Exactly. You have to spend money to successfully manage money. The better your internal tracking is, the more clearly you can show that all of your resources, including the money you spend on a bookkeeper or software, are being maximized for the mission. And that specific transparency, well, it feeds right back into the external trust we talked about in the first segment. It all connects.
That brings us squarely to our third imperative, the regulatory landscape. Compliance is the heavy lift, isn't it? Good accounting isn't just a nice to have, it's non-negotiable for sustainability and growth.
That's the hard truth. Strong accounting practices are basically the price of entry for serious funding. Many grants, especially governmental ones, they mandate extensive reporting. They require specific financial statements, audit preparation.
And are the requirements really that different between, say, a small local foundation grant and a big federal grant? Which one typically derails a startup?
Oh, federal grants are notoriously complex. They often require specialized cost accounting to track very specific activities and make sure funds aren't commingled. This is especially true if they're awarded on a cost reimbursement basis, which, loops right back to our cash flow discussion. A private foundation might be happy with your quarterly statement, but the government wants extreme detail on time spent, expenditures, compliance with regulations like the single audit. If your accounting system is weak, you will immediately increase the probability of non-compliance. And that disqualifies you from the largest funding tools out there.
So it seems like compliance is just the baseline requirement in the competitive world of grants. And if we zoom out to legal protection, poor accounting could actually be mission fatal.
It can be. Good record keeping is absolutely critical to staying on the right side of taxation laws and maintaining your exempt status. And the key compliance document here is the IRS Form 990.
The 990, people talk about it all the time, but what does it really do for a small nonprofit besides just being another tax form to fill out?
Well, the 990 is the nonprofit sector's annual public report card. Unlike private business filings, the 990 is public information. Donors use it to check a few things. Are you staying true to your mission? How much are you paying your key staff? What are your governance policies?
I see.
So if the 990 is messy or late, or it shows a glaring error like, let's say, misclassifying large expenses, it signals mismanagement to every single regulator and potential donor who searches for it online. Poor accounting could very easily lead to legal issues, penalties, or worst case, the revocation of your nonprofit status. And that ends your organization's life before it ever gets going.
So to synthesize all this, good accounting isn't just about the balance sheet or preparing that Form 990. It's a comprehensive operational and strategic system. It's about building external trust, managing internal resources effectively, especially that volatile startup cash flow, and ensuring all the rules and regulations are being followed so you can enable future growth.
Precisely. For small nonprofits and startups, the benefits of implementing clean, robust accounting practices from the very start are just. They're absolutely critical to growth, sustainability, and ultimately to fulfilling the mission. You're setting up the organizational DNA for long-term health. That allows you to focus on the program work, not the paperwork.
That was an incredibly structured deep dive into a topic that can feel overwhelming, but which we've really broken down into strategic choices. We've covered the three essential pillars for small nonprofits: building trust externally, responsible resource management internally, and legal compliance to ensure stability.
And if we connect this all back to that initial tension point, the need to spend scarce dollars on programs versus administrative overhead, we see some advice in the sources that even suggest the best nonprofits run a surplus. And this raises a really important question that every startup founder listening right now has to wrestle with. If your core mandate is to maximize program dollars and build trust through ethical spending, how do you reconcile that with the absolute necessity of spending money on robust and maybe expensive accounting tools, or paying a competent bookkeeper, or even paying yourself and your staff a fair wage? All of that counts as overhead. So what level of administrative investment truly serves the mission best in the long run, even if it hurts your program to overhead ratio a little bit in the short term?
A vital question worth mulling over, because sometimes you have to spend money strategically to ultimately save the mission. Thank you for joining us on this deep dive into the building blocks of financial success for nonprofits. We hope this has given you the necessary tools to view accounting as a strategic asset, not just a liability.